Hello everyone, Professor Watts here, and today we are going to move on and talking about hedging foreign exchange exposure. Let's recap what we've learned so far. We've talked about foreign exchange rates and calculating rates and thinking about spot versus forward markets, and we've talked a little bit about how foreign exchange rates move, arbitrage conditions that keep foreign exchange rates within certain ranges or limits, and then we talked some about derivatives in foreign exchange, so futures markets and options and so on. So we've got all the kind of building blocks we need now to understand how multinational corporations can deal with their foreign exchange risk. So we have businesses that are operating in multiple countries. They have cash flows denominated in multiple currencies. And what do we mean by cash flows? Well, money coming in, earnings, revenue, and money going out, liabilities, payables, bills, and so on. So you're either earning money or you're owing money, or in most cases both, substantial sums of money in foreign currency. And because those transactions take place over time, changes in the exchange rates can have a positive or negative impact on the business. And so we want to look at ways they can use financial markets and derivatives to eliminate or offset those risks of exchange rate. And I made a table that will maybe help us think through the possible situations a business could face. So, firm could be in one of two positions with respect to foreign currency. It could be owed foreign currency. It has foreign currency receivables, foreign exchange receivables. Or it could owe foreign currency. It has foreign exchange payables. Okay. And then with respect to the exchange rate, one or two things could happen. The value of the foreign currency could rise in terms of US dollars. So US dollar would be depreciating against that currency. Or the value of the foreign currency could fall in terms of US dollars, and that would mean the US dollar is appreciating against that currency. There's a 2x2 matrix here, so what are the possible outcomes? If you're owed foreign currency and the value of that currency goes up, you get a gain. If you're owed foreign currency and the value of that currency falls, you see a loss. If you owe foreign currency and that foreign currency goes up in value, you get a loss. If you owe foreign currency and that currency falls in value, you get a gain. So basically what companies are looking to do is saying, can we avoid the loss diagonal? We want to avoid this. Okay, we want to minimize those opportunities, and we want to stay on the gain diagonal if possible. Or we want to kind of limit our exposure to the loss part of this diagonal. We might think about it like this, kind of creating kind of a little trough here where we'll stay in this range here, be able to exploit gains and minimize losses. Okay, so you might have some loss exposure, but you can minimize it, and then you can also try to ensure your potential for the gains. Today, we're going to talk about hedging, so we can avoid the losses and try to capture the gains from changes in exchange rates. So the first thing to talk about is multinational corporations will utilize financial contracts and derivatives. So they can basically borrow and invest and or use forwards and options. Okay, so let's get down to cases now and talk about how you can hedge foreign exchange receivables. And we'll go with the kind of a textbook example here, so make it concrete and help us to think about exactly what a firm might do. So we've got Boeing exporting a 737 landing gear to British Airways and billing them 10 million pounds, and it's payable in 1 year. And that's pretty common. This firm is extending credit to its customers. Very common in business world to give your customers time to pay, especially for very large purchases like a 10 million pound airplane part. And we're talking about 10 million pounds currency value, right? Not the weight of the item. Okay, so we've got some data that we'll need to be aware of to think through our hedging strategy. So we've got the prevailing interest rates in both economies, the spot exchange rate, and the forward exchange rate. Now this kind of looks familiar to us, doesn't it? We're thinking, covered interest parity. And yes, that's kind of part of the hedging strategy that we might employ. Okay, now here's option one. When Boeing receives 10 million pounds 1 year hence, it will just convert them into dollars at the spot exchange rate prevailing at the time. So that would be unhedged. Of course, the risk there is that the value of the pound could rise or fall in terms of dollars. Okay, and let's spell out the risks of that no hedge strategy. So the first two things can happen. One is that the pound might go up against the US dollar. So in other words, a pound is worth more US dollars than it used to be. Well, in that case, we'll see that Boeing will come out ahead because they're going to be able to convert those pounds into more dollars than they previously would have been able to. Vice versa, if the pound falls against the dollar, so the pound's not worth as many dollars anymore, well, when Boeing goes to convert those pounds into dollars, Boeing's going to receive fewer dollars than they would have at the previous exchange rate. So Boeing could win or lose depending on the movement of the pound against the dollar. And there could be some significant movements here potentially over 1 year's time. Currency could move 10-20% pretty easily. So if they're thinking about the pound being worth 150, so that's a $15 million receivable. Well, if the pound falls by 20%, we're talking about losing $3 million. So that's a big deal, and that's not an unheard of movement in foreign exchange rates. So it's probably going to be in the company's interest to hedge this receivable. So let's talk about how they would do that. Step 1, just the forward market. Most direct, popular, most easy to understand. Sell foreign currency receivables forward to eliminate the exchange rate exposure. So Boeing can sell forward its pounds receivables of 10 million pounds for delivery in 1 year in exchange for a given amount of US dollars. And of course, Boeing would sell them forward at the forward rate of $1.46 a pound. Now, forward here is trading at a little bit of a discount to spot, but at least Boeing knows that if they lock in this forward exchange rate right now, they won't have to worry about the pound falling anymore. Because if the pound does fall to $1.40 or $1.30, Boeing knows that they've sold it for $1.46 and they'll be covered. All right, so Boeing delivers $10 million to the bank or the counterparty for the forward contract, and they take delivery of $14.6 million. So they've locked that in regardless of wherever the spot exchange rate might go. Now, of course, the downside of this is that the value of the pound goes up, and then Boeing would be losing out. So if the exchange rate goes $1.50 a pound or higher, if the pound goes up 20%, so the pound is now worth $1.80, let's say, to the pound, then Boeing would have received $18 million, meaning they lost out on a $3 million gain. And of course, they're going to be pretty sad about that. So you totally eliminate any upside potential of the foreign currency appreciating with a simple forward. And this graph shows how that works. So we've got the exchange rate on the spot exchange rate on the horizontal axis, and then the proceeds of the transaction on the vertical. And here we are locking in the exchange rate with the forward contract. The horizontal line here just portrays what the forward hedge gets you. It gets you a guaranteed $14.6 million, selling the 10 million pounds at $1.46 each. If the exchange rate goes down, Boeing loses. And how much could they lose? Well, theoretically, they could lose it all. The value of the pound could fall to zero. Of course, it's very, very unlikely to happen, but theoretically possible. If some currencies can completely lose their value and be abandoned. Maybe more likely that the pound will fall, 5, 10, 20% wouldn't be unheard of. So Boeing's going to wind up here losing a few $million maybe if the pound falls to, let's say, $1.30. Likewise, if the pound goes up in value, that's moving this way on the blue line. Okay, if the pound rises to $1.80, then Boeing loses out on $3 million. Okay, so you can think about the distance between the blue line and the forward hedge as the potential gain in this quadrant here that they missed out on, or the potential loss in this sector down here that they avoid. Let's summarize possible outcomes here if we had an unhedged position versus a hedge at the $1.46 a pound. So we've shown several possible future values at the end of the 1 year period. Pound is cheaper over here. Pound is depreciated against the dollar down here. And then up here we've got pound appreciating. Boeing, of course, will gain by the amount of that appreciation. And so if they hedge, they'll lose what they could have otherwise gained. Likewise, if the pound depreciates, Boeing would have lost that depreciation, and by hedging with the forward contract, they save that money that they otherwise would have lost. So you can see you completely neutralize the risk. And remember, we talked about this earlier, risk works in both directions. It's just a wider distribution of outcomes that could be good or bad. Okay, so there we go. Simple, straightforward hedging mechanism, forward contract. Okay, now let's briefly talk about futures versus forwards. Futures and forwards are similar, but they're also different in key ways. And one of the big differences is going to be that futures contracts come in these standardized lots, so to speak, standardized amounts of foreign currency that you can buy or sell in a futures contract. That's called the contract size. So I think the pound one is you sell or buy 62,500 pounds at a time, if I remember right. And delivery dates are also highly standardized: 1 month out, 3 months out, 6 months, etc. And they can't be customized because they're standardized product like a forward contract can. Forwards are tailor-made to the firm's specific needs. So if a firm is receiving, 2.8 million pounds in 90 days, they could set up a forward contract with that exact amount of money in that exact time frame to exactly offset their particular exposure. So with forward contracts, you can hedge perfectly, whereas with futures contracts, you'd have to just find the approximate number of contracts needed to offset the cash flow, and then the approximate maturity or time frame that roughly matched up to the future dates whether that foreign cash flow was going to occur. You also have marking to market with futures contracts, meaning you either get money added to or subtracted from your margin account with your futures broker on the futures exchange, and so you have constant cash flow implications over the life of a futures contract. The value can go up or down, and that kind of adds some uncertainty. If you're using a futures contract, it increases some opportunity costs, and that makes exact hedging difficult, whereas with the forwards it can be done precisely. Okay, so we'll kind of assume here that we're using forwards contracts rather than futures, although lots of companies might find it easier to use futures markets if they're not big enough to have relationships with counterparties that can create the exact forward positions that they need. Okay, now let's move on to talk about a money market hedge. Money market hedge is where if you have foreign currency receivables, you borrow in foreign currency and you time the maturity of that borrowing to match the date when you're receiving the foreign currency payable, and then when you get the payable, you instantly pay off the borrowing that you made in the foreign currency. And meanwhile, while you borrowed in foreign currency, you took that and converted it back to your domestic currency and then invested it in your domestic market, so you earned interest on the receivable over time, and then you'll offset the gain on the investment and the payout, the loss or the payout on the debt. And if you do everything right, things will roughly equalize. So kind of equivalent to what you get with a forward in terms of minimizing risk exposure.
You might come out a little bit ahead of or behind the simple forward hedge based on the interest rates in the two countries.
Let's continue our Boeing example to think about how that works. So Boeing's going to eliminate their exchange exposure from their sale of plane parts to British Airways. So remember, they have a 10 million pound receivable coming in 1 year, 10 million pounds, by borrowing in pounds, then converting to dollars, and then investing at the dollar rate. Okay, when that loan matures, they've got the pound receivable available, sitting there ready to pay off the pound loan. And if they borrow the right amount as well, so they got to establish two aspects of this borrowing, dial them in: the maturity date of the loan, and then the exact amount, which is just basically going to be the discounted amount of the receivable discounted at the interest rate over the requisite time period, so that the value of that loan at maturity is exactly equal to what they're receiving from their sale to British Airways. Then they've reduced their pound exposure to zero. They basically completely covered their pound exposure. And meanwhile, they're investing the proceeds of that sale effectively in their home currency, which would be dollars. Okay, so let's walk through the math on that. They're going to borrow roughly 9.2 million pounds. Now, how did we get to here? Well, we said, what's the present value of the 10 million pounds that they're due to receive from British Airways, discounted at 1 plus the UK interest rate to the end time periods 1. Okay, so we just took the present value of 10 million pounds at 9% interest for 1 year. Plug that in your calculator, that's what you'll get. All right, then we're going to convert those proceeds from borrowing in pounds into dollars at the spot exchange rate of $1.50 per pound, so multiplied by $1.50. So you wind up with that many dollars, $1.76 million. You're going to invest those at the U.S. interest rate, which we recall was 6.1%. After 1 year, collect your $10 million, which now this loan has matured and has a $10 million due at maturity. So you exactly offset that with the $10 million receivable. And you will receive the maturity value of the US dollar investment, $13.76 million, at compounded at 6.1%, so times 1.061 to the first power. So you wind up with $14.6 roughly million in proceeds. And we'll notice that that's a little bit better of a deal than they would have gotten by just selling the pounds forward at the forward price of $1.46 per pound. If they had done that, they would have wound up with times 10 million pounds. They would have wound up with just 1,460,000 even. So they are just a tad better off doing the money market hedge, although there's a little bit more work involved in terms of borrowing and lending, a little bit more transactions costs. Okay, what are the upshots here? Well, both the forward and the money market hedge completely eliminates exchange risk exposure. You completely take it off the table by locking everything in. But is that optimal? Well, think about this. What if Boeing could protect itself against the weaker pound, so they could minimize the risk of the pound losing value, but still leave the door open to benefit if the pound goes up in value? And what we'll see now is that an options-based hedge is going to allow them to do that. It gives them the option of selling the pounds at a higher price if they go up in value, while still, to some extent, minimizing the downside if the pound goes down in value. So here's how that would work. The firm can buy a foreign currency put option if it's dealing with receivables. That's what we're talking about here, so that's what we'll look at. And then the flip side of that, if they're dealing with payables, they could buy a call option. So remember, a put option equals the right to sell at a set price. So Boeing could lock in the price that it can sell the pounds it's receiving at, and then know it can get at least that much. If the spot exchange rate at the time of expiration of that option is higher than that, well, then they just let the option expire and sell the pounds for that higher market value, the higher spot exchange rate that might have materialized. If the higher spot exchange rate doesn't materialize, in fact, if the value of the pound even goes way down, they're still protected by having the put option and being able to exercise it. So you get the upside there, but you minimize the downside. Now you can't eliminate the downside because you have to pay for the put option. You have to pay a premium on the put option. So let's walk through the math of the options hedge procedure for Boeing with the 10 million pound receivable. Boeing purchases a 1-year put option on the 10 million pounds with an exercise price of $1.46 per pound at a premium. Here's where we have to account for the cost of the option of 2 cents per pound. So the cost of the option is going to be $200,000, 2 cents per pound times 10 million pounds worth of options. Okay, Boeing has the right but not the obligation to sell up to 10 million pounds for $1.46, regardless of the future spot rate. Assume now that the spot rate turns out to be $1.30. So the value of the pound has fallen considerably on the expiration date. Well, Boeing is now protected because they can sell their 10 million pounds at that locked-in price of $1.46. So Boeing's really happy if this is how things turn out. Boy, we're glad we bought the put options at $1.46, because they would have lost 16 cents times 10 million pounds, and that would work out to be 1.6 million pounds that they'd be down. So they're going to be very happy about this if that's how things turn out. The upfront cost is more than just the premium because there's the dollar outlay, but then there's also the opportunity cost of those dollars. What else could they have done with those $200,000 rather than buy the option? Well, they could have invested them at the U.S. interest rate of 6.1%, and that would have earned them $12,200 over the year. So the total cost of the option is actually a little bit more than just the cash outlay. We have to account for that opportunity cost of capital as well. So the net dollar proceeds then is the 14.6 million value of the exercising the option and selling the pounds at $1.46 each, minus the total opportunity cost of the option. But still, roughly 4 million. And in this case, that is the minimum downside. So they've protected their downside beyond just that $212,000 loss, and they still get all the upside, because if the value of the pound goes up to $1.60, $1.70, $2, they can capture all of that, because they'll just let the option expire and then sell their pounds at that higher spot price. All right, so here, that's what we're looking at explicitly now. The exchange rate goes up to $1.60, so the pound is worth more. Boeing's not going to exercise the option. It's going to convert the 10 million into 16 million at that rate. Subtract out the cost of the option, and they're still up by almost $1 million here. All right, so once again, just to review, options hedges. You can limit the downside risk. You can't eliminate it, because you do have to pay for the protection of the option, but you limit it, but you preserve all of the upside potential. Okay, you got to pay for that in terms of the premium. Options are going to be very powerful risk management tools for that reason. Okay, now we've looked at 3 major hedging strategies. Let's kind of compare them side by side, and then we'll wrap up by thinking about just a few other considerations with respect to foreign exchange hedging. So here's a nifty little chart that compares all 3 of those strategies side by side. Notice the blue line here, the option hedge. So this right here represents the amount you paid for the option, and if that future spot price of the pound is below our break-even price, you're going to lose the cost of the option. So this rectangle represents the $212,000 total cost of the option. But you cap your downside losses here. Your minimum proceeds is going to be the 14.38 mil. And above the break-even price, you have all the upside gain if the pound appreciates. That's represented by this upward sloping blue line here. The forward hedge is just this horizontal line here. And remember, the money market hedge turned out to have a slightly higher value, so that's going to be this horizontal line here. So the question is, are you willing to pay the cost of option premiums in order to have access to that upside potential? Okay, now we'll briefly work through some payables examples, but these are just going to be the flip side of receivables, so these should be pretty easy to understand. Now we've got Boeing importing something from Britain. They're going to buy a Rolls-Royce jet engines for £5 million, and that's going to be payable in 1 year. Again, Rolls-Royce now is extending credit to Boeing, giving them time to make payment on the products they buy. That's very common. And here's what we're looking at: U.S. interest rate at 6%, UK rate at 6.5%, spot exchange rate $1.80 per pound, forward exchange rate $1.75 per pound. Looks like covered interest parity is holding there. All right, so Boeing is concerned about the future dollar cost of this purchase. They don't have to pay it for 1 year. Right, so what should they do? Well, should they just ride things out and see what the pound costs in 1 year? Or should they try to lock in the dollar cost of the pounds that they're going to owe in 1 year right now? Well, it depends on what their taste for risk is and what they think is going to happen to the cost of the pound. But most businesses are going to find that hedging this is going to be advantageous. So we could do a forward hedge. Boeing will just buy the $5 million forward in exchange for $8.75 million. That's just buying 5 million pounds at the forward price of $1.75 per pound. They could use the money market hedge like we discussed above. And with the money market hedge in this case, Boeing is going to borrow dollars, convert those into pounds, and then invest the appropriate amount of pounds at the British interest rate, which it was 6.5% if I remember right, such that that's going to equal the 5 million pounds upon the maturity of the investment. So they don't need to invest 5 million pounds, they need to invest the present value of 5 million pounds at 6.5%. So that is the amount of pounds they need to invest. Now, to acquire those pounds to invest today so that it'll mature into 5 million pounds in 1 year when what their payable is due, they'll need to spend $8.45 million. That's this amount of pounds at the spot, converted at the spot exchange rate of $1.80 per pound. So that looks a little bit more attractive than just buying 5 million pounds forward at $8.75 million. That looks like you save about $300,000. But you don't actually save $300,000 because the future value of that $8.45 million is actually $8.957 million if you think about investing it at the US interest rate of 6%. So the money market hedge does cover you, but it will cost a little bit more than the forward market hedge in this case. And then finally, the options market hedge. Boeing will just purchase a call option on 5 million pounds, the right to buy 5 million pounds at whatever price they can get for that option in the options market. And then they know that if the price of the pound goes up, let's say, if it goes up significantly above 175, which is the current forward price, and let's say they can buy this at $1.75 per pound, just for example. So if the pound goes up to, let's say, something crazy like $2, well, they would save themselves, something like $1.25 million, because if the pound went up to $2, well, now their 5 million pounds would cost them 10 million bucks, versus locking in the price of 175, as we remember from the forward market, is only going to cost them 8.75 million bucks. So that's a really good move if they think the pound is going to appreciate. If the pound depreciates to less than $1.75, well, then they just let that option expire, and they'll have to, of course, eat the cost of the premium of the option. Here's a nifty little chart that compares side by side the alternatives for hedging the payable. Option hedge protects, minimizes exposure for an increasing pound. We've got a break-even price here of $1.73 per pound, and then this area in here would represent the cost of the option, the total of the option premium. The money market hedge, which we'll recall, was ultimately going to cost us $8.95 million, or the forward hedge, which is going to cost $8.75 million. So the forward hedge is the best if you don't want to deal with any of the risk, but if you're willing to pay the option premium here in order to possibly benefit from the risk of the pound going down in value, you have a potential tremendous upside with respect to being able to acquire those pounds at a cheaper price if the pound goes down significantly, while still minimizing your downside loss of pound appreciation here. So you'll notice that this is just a mirror image of what it looks like with hedging receivables. Forwards, money market, and options, 3 primary hedging strategies.